on Business Incorporated today. United Nations provides $20 million for food security in Sudan. South Africa's jobless rate declines for the first time since 2020. And Kenya's central bank hikes interest rates for the first time in almost 7 years. Hello and welcome to the program. I'm Will Ibong. We start off as always with market numbers from Africa, where sentiments were mostly positive at intraday. Nigeria's NGX was in the red at intraday. Its index was trading 0.6% lower, but still maintaining the 53,000 points, while South Africa's index was in positive territory, up by 0.22%. Egypt's equities market was also in the green, up over 1%. Meanwhile, the Nairobi Stock Exchange ended Monday's trading session in the red. Now to the Middle East, where major equities traded mixed at intraday. The Abu Dhabi index rose by 0.7%, while Dubai was slightly down 0.01%. Still within the region, Saudi Arabia edged lower, down by 0.1%, and the Qatari exchange was up 0.2%. Over to Europe, where EU leaders have agreed to a compromise plan to ban imports of Russian oil. Rob Watts is standing by in Berlin with details of that and more. So, Rob, what does this plan to ban Russian oil imports look like?
So it does not look like the total embargo on all Russian oil imports that the majority of EU leaders had been pushing for, but it does cover more than 2/3 of the Russian oil that enters the EU. When we spoke yesterday, you may remember I mentioned a proposal to exempt oil delivered by pipeline from the ban. And in the end, that is precisely what has been agreed. So the embargo only covers shipments of oil by sea. But as I said, that is the majority of the Russian oil that the EU imports. The president of the European Council, Charles Michel, says the agreement cuts off a huge source of financing to Russia's war machine. And he also stressed that the exemption for pipeline oil is only temporary. So this is the familiar EU story of kicking an awkward decision down the road to be worried about later on. But there were those, of course, who thought no deal at all would be struck. So leaders will be at least happy that some sort of embargo has been agreed. It also means that the other sanctions as part of this sixth package against Russia can go through as well, including banning Russia's biggest bank, Sberbank, from the SWIFT payment system and banning 3 state broadcasters as well.
So we saw in the news, Germany has posted yet more concerning inflation figures. It's about 7.9% in May. How severe is the problem?
Well, it's the most severe since the reunification of East and West Germany in 1990. Inflation hit 7.9% in May, having been at 7.5% the previous month. You actually have to go as far back as the oil crisis of the mid-1970s to find inflation as high as that anywhere in Germany, so half a century. What's driving inflation? Well, overwhelmingly, the problem is energy. Energy prices are almost 40% higher in Europe than they were a year ago. Ask anyone in Germany and they will tell you that their bills have shot up since last year. They'll also tell you that prices in supermarkets are rising too, and food costs have increased actually 11% since last year. A major driver of the surge in energy and food prices is, of course, the war in Ukraine. Supplies of things like wheat are struggling to get out of Ukraine, and the war has also made Russian oil and gas supplies uncertain, driving up the prices of both of those. The other big drive are, of course, the supply necks caused by the resurgence of demand following the coronavirus pandemic. Suppliers are still struggling to catch up with that. And as a result, life is getting more expensive here in Germany.
We're all still struggling to catch up, Rob. Now, have those inflation figures had an impact on the markets?
Well, actually, both the things that we've just been talking about have had an impact on markets. Let's look at the inflation thing first. The size of the increase in inflation took a lot of investors by surprise, and it has therefore increased nerves about the pace and scale of interest rate hikes from the European Central Bank, which has so far resisted raising rates. In terms of equity markets, most European markets actually ended Monday slightly up because relief over the easing of pandemic restrictions in China outweighed inflation concerns. However, Eurozone bond yields did jump on Monday. The other thing we talked about, the partial EU ban on Russian oil, has also had a major impact, this time on the price of oil. Brent crude breached the $120 a barrel mark on Monday. It actually hit $122 at one point, the highest in 2 months. One to watch on Tuesday is Eurozone inflation figures, which are due out. How much prices are rising across the countries that use the euro is likely to play a big role in how European markets perform today.
Thank you so much, Rob, for the update. We'll continue tracking that and we'll have more updates tomorrow. Thank you so much. Now to the UK, where the cost of living is rising exponentially and citizens are really feeling the pinch. Juliana joins us from London. Hi, Juliana. Credit card borrowing has hit a record since 2005 as more families are finding it harder to pay bills and buy food. The squeeze keeps on squeezing, right?
Yes, good afternoon, Will. We've had fresh data from the Bank of England, which has really shone a light on the cost of living crisis. Last month, in April, Brits borrowed £1.4 billion on credit cards. As you said, this is the highest rate since 2005, so over 16 years. And on the flip side of that, we're seeing that mortgage demand is also slipping. I think a lot of economists are citing high interest rates because, of course, the Bank of England is trying to lift interest rates to abate inflation. But the knock-on effect is that if you are not on a fixed rate mortgage, your payments are going much higher. And the data suggests that some people are holding back on getting a mortgage because they want to avoid some of these high payment rates that they are getting. We know that inflation is currently at a 40-year high in this country. From March to April, it jumped 2% from 7% to about 9%. And it is really getting difficult for people, which is why some of them may be relying on credit to fund their lifestyles. On the flip side of this, I think some economists are a little bit happy or jubilant, should we say, about this data because it does show that perhaps consumers are not so cautious as some people may have thought. There are concerns that we could be heading into a recession because, of course, if your pay packet is not going as far as it was this time last year, you may be putting back on spending. But because people are spending on credit cards, it does assume that people are willing to spend. They're not going to be as cautious, which could in turn mean that the economy won't suffer as expected to suffer. But of course, these are still very, very early days. We are looking in the rearview mirror, so we'll just have to wait and see what May brings us.
Using debt to survive is really not a good option, but what can we do, Juliana? We just have to, like say, wait and see. Now, on the flip side, we've seen some good news that the UK is set to offer work visas to graduates from the world's top universities, and this is regardless of their country of birth. What's the plan here, Juliana?
Yes, it is regardless of their country of birth. However, unfortunately, no African countries are in this list thus far. This is all about Priti Patel, the British Home Secretary's points-based immigration system. Very controversial, but Britain are really only willing to open their doors at the moment, it seems, to people that they deem worthy of coming to this country, which is pretty shocking, actually. But yes, so this new £750 visa is for individuals that have a master's, a bachelor's or a PhD award degree from the top 50 universities in the world. No surprises, 20 of these institutions are American. There are some in China, Japan, Canada, Singapore and France, and of course Switzerland too. You will have to go through a criminality check and a background check, but we know that Britain, particularly in this post-Brexit time, are really keen to forge not only new ties around the world, but they want to attract the best of the best, particularly in the early stages of their career. So I believe that the British government are doing this because they want to make sure that they're able to fill this skills gap that appears to be lacking in the UK at the moment, which is why vacancies are at a record high. Over 1 million vacancies available in the UK at the moment. One of the reasons why they're struggling to fill them is because they don't have people with the skills. So they believe that this new points-based university system will allow them to get the best workers in the system.
So, Julian, I think African universities have a lot more work to do, right? So now, how are markets? Are they looking good today?
Yeah, markets are good. The FTSE is actually flying high, record highs at the moment, well over above that 7,600 mark. As you were discussing in Germany, we know that the barrel of Brent crude, the benchmark for oil prices, hit above $124. So no surprises that leading the FTSE at intraday is BP and Shell. But having a closer look at the numbers, the all share is up 0.17%, FTSE 100 up by 0.30%, and the FTSE 250, the domestic market, down currently at 0.45%. In the currencies market, the British pound is trading down on the US dollar by 0.45%, though up on the euro by 0.23%, and down on the Japanese yen by 0.26% at intraday. Will.
Thank you so much, Juliana, for that update. We'll keep track of the market as usual.
Thank you.
Now, shares in Asia Pacific were mixed today as investors watch for market reaction to the release of official Chinese factory activity data for May. The Shanghai Composite in mainland China advanced 1.19% on the day, while the Shenzhen component jumped 1.92%. Hong Kong Hang Seng Index climbed 0.89 as of its final hour of trading. And now China's official manufacturing purchasing managers index for May came in at 49.6, an improvement over April's reading of 47.4. In Japan, the Nikkei 225 closed 0.3% lower, while the Topix index declined 0.51%. Over in South Korea, the Kospi climbed 0.61%, ending the trading day. Australian stocks closed lower as the S&P ASX 200 dropped 1.03% to 7,211.2 points. Now, the S&P 500 futures fell in early trade today following last week's bounce on Wall Street. The U.S. stock market didn't open on Monday, if we remember, due to the Memorial holiday. Dow Jones Industrial Average futures shed 0.46%. S&P 500 futures, dipped to the same margin, and NASD, the Nasdaq 100 futures, also fell 0.12%. These moves followed the best weekly gains for the Dow and S&P 500 since November 2020. The Dow closed up 6.2% for the week, ending an 8-week losing streak. The S&P 500 gained 6.5% and the Nasdaq gained 6.8% on the week, ending positive after 7 continual weeks of losses. Solid earnings from the retail sector as well as an inflation report that showed prices could be easing lifted investor sentiment. A chunk of last week's gains came from Friday when the Dow rallied more than 550 points and the S&P 500 popped 2.5%. The Nasdaq, meanwhile, rallied 3.3%, boosted by a solid report from tech companies as well as a dip in the 10-year Treasury yield. Now, Salesforce, HP, and Victoria's Secret are expected to report earnings today after the bell. Oil prices jumped after EU leaders reached an agreement late on Monday to ban 90% of Russian crude by the end of the year. During Asia hours on Tuesday, U.S. crude futures for July were up 3.53% to $119.12, while Brent crude futures rose 1.87% to $123.95. Contracts for August also traded higher. WTI crude jumped 3.6% to $116.34, and Brent was up nearly 2% to $119.96 per barrel. The agreement resolves a deadlock after Hungary initially held up talks. Hungary is a major user of Russian oil. Now, the embargo is part of the European Union's 6th sanctions package on Russia since it invaded Ukraine. Talks to impose an oil embargo have been underway since the start of the month. Gold prices fell early on Tuesday as U.S. bond yields firmed and the dollar strengthened, with bullion heading for a second straight monthly loss for the first time since March 2021. Spot gold fell 0.3% to $1,849.92 per ounce, bringing its monthly loss to 2.4% so far, and is the biggest loss since September. U.S. gold futures also slipped 0.3% to $1,851.90. Gold slid from just below $1,900 an ounce at the start of the month to $1,786.60 per ounce on May the 16th as the dollar surged to two-decade highs. Spot silver dipped 0.6% to $21.82 per ounce and is down about 4.1% so far this month. Platinum fell 0.5% to $954.48, but is still set for its first monthly gain in three at about 2.5%. Palladium gained 0.5% to $2,042.69, but is down about 12% this month, its most since November. Now, commodities market update next, right after the break. Just stay with us. Welcome back. The Russia-Ukraine war has roiled energy markets, especially natural gas. Russia and Ukraine control no less than 16.42% of the global gas market. The EU member countries are very dependent on Russian gas for their heating and energy needs. And since the war, the price of natural gas has increased by about, really high. Meanwhile, the EU is seeking energy sources away from Russia, and Nigeria is leading producer of LNG, with a capacity of approximately 22.2 million metric tons. Ifan OTC, analyst at financial derivatives company, joins me to discuss how Nigeria is positioning to benefit from this. Hi, Ifan. Good to have you.
Thank you for having me.
Now, Ifan, what's the short-term opportunity for Nigeria, considering the sudden spike in the price of gas?
So it is true that the Russian-Ukraine war has roiled gas market prices, which is unfortunate. This is something that was unforeseen. It's also true that with the sanctions that have been imposed on Russia, and bearing in mind that we are approaching colder months, the European Union has been strategically looking to diversify its natural gas sources so as to meet its domestic demand. Now, we've seen a situation where European countries have approached African countries such as the Republic of Congo, Angola, and Mozambique, which were approached by Italy a few weeks ago. And then recently, we've seen that the German Chancellor was recently in Senegal discussing alternative gas supplies from West Africa. So these are developments that we're seeing. Now, to answer your question with regards to how this will affect Nigeria and how Nigeria can benefit from this is a huge opportunity for Nigeria to benefit from this. So we'd see a situation where there'll be financial investments in Nigeria, which Nigeria can use to boost its infrastructure, build pipelines, build ports, build roadways, develop its gas reserves. Let's not forget that it will also help boost or help generate or create job opportunities and overall foreign earnings, which is what we really need, foreign earnings. So those are things that Nigeria would benefit from.
So, well, how do you think Nigeria can really leverage on this, considering that natural gas is considered a sustainable alternative to brown energy, and the world leaders are really moving towards that segment now?
Okay, so I am of the opinion that natural gas, which we all know is associated gas from crude oil, is not really a renewable source of energy. So, however, we know that it's a cleaner source of energy, being that it emits lower carbon compared to other fossil fuels. Now, one way we can see, we've seen that Nigeria and other gas-producing countries are clamoring and campaigning that natural gas be included as an alternative source of energy. Now, the EU has recently proposed that it would consider adding natural gas as a green source of energy. Now, when that happens, Nigeria and other gas-producing countries stand to gain a lot. So we would benefit from increased financial investment, seeing as foreign companies and foreign investors would want to be seen to be taking part in protecting the environment. We would see creation of job opportunities. We would see finances or financing with regards to boosting our gas reserves and overall boosting of the Nigerian economy. So the Nigerian government would have diverse economic resources of revenue. So those are things we can expect.
Okay, we already have the NLNG, which is a model that has been, is seen as the golden standard for joint ventures between oil majors and host countries, which is we're practicing here in Nigeria. Now, however, the NLNG has become a cash cow. Nigeria owns 49%, stake in that, but the management has been left in the hands of the technical partners. Are there any lessons to be learned from this?
So the Nigerian LNG is a company that's owned by 4 major partners. So the Nigerian government, that's represented by the NNPC, owns 49%. And then international oil companies, which are Shell, Total, and Eni International, own a combined majority of 51%. Now, the NLNG has been branded as a leading or successful business model with unimpaired revenue. So it's seeing a steady source of income. Now, what I would say is this success story can be seen to be contributed by several factors, which include the fact that it's an incorporated joint venture, the fact that it can raise funds by going into the financial markets, be it the capital markets or money markets, and also the fact that it is immune to external influences. Now, I am of the opinion that the Nigerian government should sell its stake to the Nigerian public. Now, to do that, it needs to go to the NGX and sell its shares to the Nigerian public. Now, this would boost accountability, transparency, would also make it boost or generate investor confidence generally in the government. Now, research has shown that publicly traded companies are more accountable, are more transparent, and generally have more corporate governance compared to privately traded companies. So even though the NLNG has been heralded as a company that has a successful business model, I think it can take it a step further by making sure that it's Nigeria's stake, or when I say Nigerian stake, I mean the NNPC stake, is available to the Nigerian public to trade and invest in.
Okay, so if I will see how far this goes. Thank you so much for sharing your insights on the program.
Thank you for having me.
Now, the United Nations Humanitarian Coordinator in South Sudan has announced a grant of $20 million from the UN Secretary Emergency Response Fund for Sudan. The UN Coordinator, Mrs. Kardiata Lo-Ndiaye, says the grants will help in the purchase and distribution of seeds and also provide critical nutrition and support to farmers in Darfur. The breakdown of resources showed that the Food and Agriculture Organization received $12 million. The UN Children's Agency, that's UNICEF, will receive $7 million, while the World Food Program will receive $1 million to provide logistics support. And in South Africa, the unemployment rate has decreased by 0.8% to 34.5% in the first quarter of 2022, the first time since 2020. According to the Statistics South Africa, the biggest job gains were recorded in community and social services, manufacturing and trade. The youth aged 15 to 24 and 25 to 34 recorded the highest unemployment rates of 63.9% and 42.1%. Also, the Black, African, and colored population groups remain vulnerable in the labor market.
Let us look in terms of employment. The number of those that are employed has increased from the fourth quarter of 2021 by 370,000. And in this regard, we see a lot more increases in the community and social services by 281,000. And we see an increase again in terms of manufacturing by about 263,000. And we see an increase again in terms of trade by about 98,000. And of course, there were decreases in other areas like construction, in terms of private households and them. And in this regard, that increase of 370,000 in total, when we have done the additions and the subtractions, brings us to about 14.9 million people that are employed as in the first quarter of 2022.
Now, Kenya's central bank has unexpectedly raised its key interest rates by 50 basis points to 7.5%, its first hike in almost 7 years. According to the central bank, the decision was taken because of elevated risks to the inflation outlook due to increased global commodity prices and supply chain disruptions. The central bank adds that surveys conducted ahead of the Monetary Policy Committee meeting showed concerns remained about rising inflation, the impact of the war in Ukraine on commodity prices, supply chain disruptions, and increased political activity. In April, inflation quickened to 6.5%, edging closer to the central bank's 2.5% to 7.5% target band. And that's it on Business Incorporated. I'm Will Ibong. Thanks for watching. Bye for now.